Thanks so much, and really appreciate you and introducing me and everything else. Anne wears lots of hats, and she's a newer team member, but she's just doing a fantastic job, and we're so excited. So thank you, Anne, and to all of you, some of whom have come back for more of my ramblings, and we very much appreciate that. So thanks for coming back, and thanks for sticking with us. And uh, you know, what fun is running data if you can't share it with the people? I guess I'll just say that. Okay, so let me get my screen shared here, and we'll kind of jump right in. All righty. So first things first, I know Anne mentioned, just want to welcome you guys again to this week's COVID-19 market update. I am still Mars Director of Research, David Arbit. And first of all, we always insist, oops, let's move my little thingy. We always insist on giving a shout out to our many wonderful sponsors. Well, I guess four, I don't know if that's many, but to our four excellent corporate sponsors. So thank you to Bell Mortgage, North Star MLS, RCU Royal Credit Union, and Supra. Want to just give a shout out to those sponsors and thank them for their support. And next, just trying to measure the impact of COVID on the marketplace. Only looking at residential activity, mostly looking at the Twin Cities, 16 county metro area, but we may dive into some individual areas depending on timing. So I mention this every week, and I'm not ready to stop. We hope this finds you and your loved ones safe and healthy. We also understand there have been some events in Minneapolis, and I think we'd be remiss not to mention them. And on behalf of myself and Mar, our hearts go out to the Floyd family, Mr. Floyd and the Floyd family, and anyone else who was impacted by the events that followed. Surely a lot of tragedy to go around over the last 2 weeks. And I just want to mention that, as a Minnesota, as a state, Minnesotans have always gotten through these challenges. And I know that we will get through this one too. It'll take some time, and there's definitely a lot of work to do to close some of our gaps and address some of the issues that these events have raised. So I just want to acknowledge that and not to skip over it. So, well, I should mention, guys, we have a wonderful COVID resource page. So just mplsrealtor.com/coronavirus resources. You guys will see a whole bunch of wonderful kind of categories from our business operations to guidance on your practices, whether open houses, etc. I'm a little partial to our local housing market updates because that's where I spend a decent amount of my time. Lacey and her team thinking through EPD, how to keep you guys sort of educated and how to keep our classes going. Eric, my colleague Eric Myers, works pretty hard getting a good list of what's happening at the federal, state, regional, local level for you guys, whether it's PPP loans, SBA, changes in policy, Federal Reserve, easing, all that kind of thing, all that kind of stuff, sorry. And then, of course, here we are at our weekly webinar. So you are here, and I'm here with you guys, and we're pretty excited. So I think I say this every week too, but I don't want to discount it. Data is knowledge, and knowledge is power. We know this to be true. We know this to be true, and I just want to mention that there's a lot of reasons to do this, but a big part of it is to empower you guys with the tools you need to do your job and your work in helping people reach their real estate goals. But it's important to be equipped with the tools and to be armed with the tools that you guys need to succeed. And we know data is one of those tools. There's many others, but we know that data and market knowledge and market reporting and intelligence really is a big part of the power that you guys bring to the table when serving your clients and serving our region. So want to mention that. Here's kind of how things will go. We're going to spend most of our time on number one here, talking about the market. We're going to dive into showings. We're going to talk about buyer and seller activity. And wherever possible, I'm going to do my best to break things down by price point. So we'll kind of highlight the different price ranges because, as it turns out, most of you won't be surprised to hear this, but what's happening in the market for a $250,000 house is not the same that's happening for a home in the over $1 million market, or even over 600,000 or 800,000. So just a word on that. We will dive into price ranges to sort of highlight and illustrate those differences. Next, we're going to talk about our market reports and InfoSparks. And then lastly, time permitting, depending on questions and how long we spend on InfoSparks, I want to also walk you guys through a little bit of an economic update and talk about our recovery so far. All right, so again, kind of setting the scene before we dive into the meat of it. Everything still depends on these three things, you guys. The length of this pandemic, and there's some evidence it's easing a little bit. Still some concerns about a second wave, and surely people getting out and gathering in close proximity may not bode well to eliminate this thing sooner, but we'll see. And then, of course, too, the impact of unprecedented levels of stimulus and relief. And then third, the consumer response or that consumer reaction and how that drives their spending and behavior. This is kind of how I think about where we're at. We have COVID kind of pulling this tug of war on this side of the flag, or maybe handkerchief. And then over on this side, we've got Congress, right? House, Senate, executive branch, our leadership. We've got the Federal Reserve. This is Jerome Powell, making sure that our economy is supported, that we have the liquidity that we need to make sure the economy is working and functioning. And then third, but surely not least, our scientific community, right? Science is real. We believe in science. We think that our public health experts really can go a long way to start to address this pandemic, whether it's vaccine or getting best practices or social distancing or flattening the curve, whatever it is, hats off to our public health community, as well as our nurses and doctors kind of supporting everyone. Okay, so today I get to talk about the love of my life, residential real estate. Here's Phil Dunphy. I just love the look on her face. Wait a second. I thought I was the love of your life. Don't tell this to my wife. Of course, she's the love of my life, but I also love residential real estate and data. So brace yourselves, folks. Data analysis is coming. So here we go. Let's start on the market. So here we have a rolling weekly average of daily showing counts. I think you guys have seen this one. Most of you have, except every time it's different, right? Every time we have updated data. And so that's one of the reasons it's important to continue to update this for you guys, so you can see some of the changes happening and some of the developments, as well as, I think it's useful to highlight some of the events that may be driving some of this. Easter Passover probably is responsible for this little blip. Looks like Mother's Day caused in large part this little blip. Here we have Memorial Day. I have highlighted the George Floyd incident here. That was on the same day as Memorial Day, so kind of right here. It looks like these two events may have caused this showing trend to fall a little bit. The next slide is going to show you guys why I don't think that's the case. So this is through yesterday, right through June 3rd. So yesterday, pretty recent. Next, we're going to actually look at that 2019 trend, and we're going to co-plot this year's showing trend, the 2020 trend, along with the 2019 trend. So here we are through 6/3. You guys will notice this little, the decline and the bump, and that's the decline and that bump. And so a couple things that you'll notice. First of all, this year started off really strong, but as I like to remind us, 2019 was fairly suppressed because of some late snowstorms and a pretty strong melt, a pretty fast melt, I should say, that caused issues. But you can see 2019 kind of kept going. When 2020, when COVID hit, we obviously had this pullback, but we've gotten back and then some. We've gotten all the way back to these levels, and then we've added some on. But here's what's so interesting. Given this 2019 trend, it's possible that we've already seen our peak for showing activity. If you look at 2019, right, this was the peak. And so we've kind of hit this second peak after, looks like this Mother's Day little decline. You guys can see how the Easter Passover time sort of align here. So after Memorial Day, as we move into June, there's still a really healthy volume of showings, but we don't tend to see increases over these spring levels. And remember, guys, showings are a leading indicator. So if pending sales or purchase agreements, signed contracts, if those tend to peak in May or June, or I suppose July sometimes, usually not that late, then you'd expect showings to sort of reach their peak maybe a month or two earlier, depending on, I suppose, the strength of the market and pricing and rates and everything else. job market and unemployment, which we'll talk about if we have time. But I think this is, maybe some aren't thrilled to learn that perhaps showings have peaked for the year. But what I am encouraged by is look at how nicely these trend lines have sort of synced up a little bit. So we're going to look to make sure we can kind of follow this trend and that we don't fall much below it. Although, to make up for this gap, you guys see this kind of delta here where 2019 kind of did this and 2020 kind of did this. It would be nice to be a little bit ahead of these levels just to kind of make up some of this gap. I'm not positive we will, but we could. So we'll have to kind of watch that one. Depending on pent-up demand and all these things. But, rates are pretty good. And as we see the health situation continue to improve, no, we're not out of the woods, but we have seen some improvement. Again, given rates as low as they are, which is actually near record all-time lows, and assuming the health situation continues to improve, it's not unheard of. It's not impossible that we would see this blue trend line 2020 outpace 2019 a little bit. So pretty interesting note there. And as you guys see, as we get into July and August, here's the 4th of July. You guys can really see the 4th of July, that huge dip there. But it looks like, there was a little bit of displacement where as this was down, this next week was sort of up, even if maybe the trend is a little bit more like this because we were down, then we kind of had to make some of that back by being up. But the overall trend is that as you get into July and August, you tend to see showings drop off. But again, the activity here in May usually forecasts June offers and maybe July or August closing. So just a reminder, there's a life cycle of a listing, right? First it's active, then you have first it's a new listing, then it's active, then you have a showing, then it's under contract, then it closes. So just a reminder on that life cycle idea. Okay, we're going to speed through this because I know this has been here since kind of day one, and I still think it's important, but I don't think we need to spend quite as much time. If the affordable segment of the market is slowing down, which we've also seen some evidence of a little bit of recovery there. You just think of where the job losses hit: leisure, hospitality, restaurant, retail. This is going to be affecting younger first-time buyers shopping in that affordable, entry-level or first-time buyer segment. Let's transition all the way to the opposite side of the continuum and talk about luxury buyers, right? There's still this wealth effect where luxury buyers seem to be more affected by activity in stock market. We've seen some decent recovery in the Dow and the S&P, so maybe this wealth effect isn't as pronounced, isn't as dramatic now as it was, but there's this perception of wealth, whether it's real or not, right? That perception is reality. And we know that when a high net worth individual may have lost a pretty decent share of their assets or net worth when the market was down 25, 30%, they're not going to be as confident. They're not going to be as confident to spend big bucks on luxury properties. Again, there's evidence that's changing. So does that leave the middle market where we just have, I don't want to call them boring, but your typical salaried professionals who are able to work from home? Maybe they've got growing families, new household formation. So perhaps the middle market will do the best. So here we go. Here's April. We don't have May quite yet, but we can see where a lot of the job losses were in April. There you go, leisure and hospitality. Just in case anyone's new, I'll mention some people are still surprised by declines in health. Obviously with school closure and all the at-home learning, saw some changes to our education sector. But the health sector, they're not doing any elective procedures. So, that includes a lot of things. Knee replacement, hip replacement, implants, I guess other things that aren't necessarily mandatory, especially in the midst of a pandemic. Who did the job losses hit the hardest? So this is March. Couldn't find this for April, but I do think it paints a pretty compelling picture. So look, you guys, almost all of the job losses hit folks with a high school degree and less. So those with associates or bachelors obviously tended to fare a little bit better. Guess what? Low wage jobs tend to be low skill jobs, tend to be the folks working those jobs tend to have, high school educations and under. And when you think about, again, retail, leisure, hospitality, that's where a lot of these losses kind of occurred. Let's check the chat real quick. Oh, okay. Nothing that earth shattering. Okay, let's keep going, guys. So first-time buyers, we know they're making up a smaller share of the market because prices have risen, because of the supply crunch and the ongoing and persistent shortage of affordable, well, shortage overall of all housing, but especially affordable. So 1 in 3 buyers were first-time buyers. This is national. You guys can see when home prices went on sale in '09 and 2010, first-time buyers could actually be half of the market. So I'd say we're probably a little bit below our long-term average. I guess I haven't calculated it, but it appears to be maybe 36 or so to me, maybe 35 or 37. So you'll note we are a little bit below that. Median age stands to reason as they're making up a shrinking share of the market. That could change, but as they're making up a smaller share of the market, it turns out they're getting a little bit older as they're waiting or as they're putting off purchases. So the median age used to be 30 again when prices were on sale, and all these first-time buyers, all these first-timers were in the market. Of course, the median age was 30. Prices have risen, then it's 31 years old, then it's 32, then it's 33 years old. The median. So as a median, as we know, half of first-time buyers were over 33. The other half of first-time buyers were younger than 33. I'll make my corny joke as I do. It turns out most buyers age roughly 12 months each year. If you're me, you get about 18 months older every year. All right, a note of levity here. Millennials living through their second once-in-a-generation economic collapse, forcing a smile and giving each other elbow bumps. Millennials waiting for the housing market to crash so they can buy their first home, kind of licking their lips and licking their chops there. I think they may be waiting, honestly, given where rates are and given the shortage. I'm not convinced we'll see price declines. We'll talk more about that. It's possible. Again, depending on the length, the response, and the efficacy of some of our interventions, we'll see. Here's Mr. Wonka. Oh, you owned your home with a 9-to-5 job that doesn't spill into your personal life and doesn't require a bachelor degree. Hey, why don't you tell me more about how easy my generation has it? I don't know, kind of funny. So here's our theory, you guys. If the top and bottom could be performing a little bit worse, might the middle then be performing the best? So let's see. I love this one. This is easily one of my favorites. I'd even say maybe my top 10 slides of all time, just because of the picture that it's able to paint. So change in showing activity by price range. This is going back a couple months. This is that last week of March versus the second to last week of March. You guys will notice showing activity down across the board. 45% for a million plus, only about 20% for that middle market, a $375,000 home or 4.25, where a lot of that activity occurs. Because so much activity occurs here, note that the declines, overall weren't as bad as these segments of the market because it's a pretty small share of the market. Okay, fast forward from that last week of March to that, I guess, second week of April. So everything is down in late March. Here in maybe mid-April, some up, some down, some up, some down, couple up, one down, couple up. So kind of a mixed bag here. But then look at this one. This is where I think the magic happens. That week ending 419 versus 412, substantial gains in showing activity across the board. So, this really seemed to be our recovery week, that, second to last full week of April, really seemed to be that point where, we transitioned from across the board declines, and then we kind of had this transition week where some up, some down, and then we had these across the board gains, almost 100% in one of our luxury segments, but 20, maybe 15 to 30% in some of our more popular segments, but 50% in some of our other segments that are still pretty popular and pretty decent amount of volume there. And then more recently, 517, haven't quite gone through our latest numbers, but just notice here, now we're more like 10, 15, 20%. We still do see some 33, 35% up here, but we're not seeing 50% gains that really aren't sustainable. We're a little bit more in that, say, 10 to 20 range. So that's encouraging. So I don't know why, guys. Just paint the Z here, paint a big Z, and you've got everything down, some up, some down, everything up by a lot, and now most up by, I guess, a more moderate amount. Again, I can't say we're out of the woods. I can't say the worst is behind us, but we really do seem to have turned a corner, and that's pretty encouraging. All right, so just kind of digging in, we did see a loss here following gains combined with gains elsewhere. Here's our most recent. So this is for the week ended 5/22 versus that week ended 5/29. So it's last Friday. Okay, down 10% between 300 and 400,000. Actually, up a little bit for 500 to 600, and the big gainer up 4.5% for a 650 or a $700,000 home. I know that's a little bit rich for some, but we've got a pretty high performing metro with a lot of pretty solid jobs and a lot of good companies with good leaders. So we're a pretty high earning region. So maybe it shouldn't be too surprising that we're seeing gains there. And again, that's also a second or maybe even a third move up home. So I think there could be, again, some challenges in this entry level. We've talked about some challenges in million plus, and we can kind of see. So maybe these middle markets or second or third move up markets, are performing the best. So that makes some sense. Just a quick anecdote on showings. I've mentioned this before. We're still hearing from our builder friends. They're saying that even though showing traffic is down, it seems to be a higher quality traffic. That comes from more motivated buyers, more serious buyers. So the true qualified buyers are still there in the market, still shopping. But those fringe buyers, or the looky loons, as some call it, have likely moved on. All right, again, our most recent numbers. Sometimes I show you guys kind of past weeks, but I think we're going to jump to the latest one here. This is overall showing activity by price. We've got our previous week and then our most recent week in gray. So, as we saw in that first chart that compared 2019 to 2020, we have noticed some declines. I don't believe they're due to some of our recent events and turmoil in the city. But again, I think they follow this overall trend where, as we get out of May and into June, we tend to see showings, kind of top off, level off a little bit. And I do think that's what we're seeing here. There's our gainer. There's our $600,000 to $800,000 range. Looks like our only one that has posted a gain. This looks flat. So $500,000 up to 600,000 looks flat. $1 million plus down, 800 to $1 million down, and then 600 to 800 up just a little bit. That was activity week to week, kind of showing the change in volume or units, right? Think of this as units or individual showings. But here I want to look at the market share, right? The share. So notice this is percentages, not raw numbers. So, here's a gainer. Showings in this 600,000 to 800,000 range now make up a little bit over 5% of overall showings, up from about 4.5% the previous week. $1 million plus showings are making up 1.4% of the market. So roughly 1.4 showings out of every 100 showings are on million plus. You guys can see these three segments make up the vast majority. Let's just do a little back of the napkin math. Call it 20. Yeah, just call it 20 plus 20 plus 20, right? 60% of our market happens in these price points. Not surprising, guys. For a long time, our median sales price was in this range, 260, then up to 270, then 280. Now we're actually 305, believe it or not. But I know a lot of folks are still shopping in these ranges, and we do still have some product there. Obviously not as much as we used to. So there's still some challenges there. But I just kind of wanted to show you guys the lay of the land. I kind of like this one. It says 1 in 5 showings was on properties priced between 250 and 300,000. So it's kind of a good way to answer questions from, I guess, mostly sellers, but maybe buyers, but also for you guys, just to kind of monitor your performance and how you're doing. We talked about this a little bit. I guess I jumped the gun. Apologies. Life cycle of a listing. Just a refresher. It's new. Then it's active, then you have a pre-approval letter, then you go to showings, most of the time anyway, then you write an offer and you have a pending sale, then you have finally a closed sale, and we get price data and all the other data that comes with the closing. So, if you want to get a little bit ahead of pendings, Well, look at mortgage applications or look at showings. So as we see gains in mortgage applications, we tend to see gains in showings, and then we tend to see gains in signed contracts, and ultimately we tend to see gains in closed sales and that ultimate demand indicator. Well, I shouldn't dismiss this. If people want to know, gosh darn it, inventory's been so low, when will we see the number of active listings increase? Well, one leading indicator of that is new. The issue lately is that buyers have been writing contracts so quickly on these new listings that they don't spend a lot of time under active status. So obviously we got a fast-paced market, pretty competitive market. I suppose a little bit less so than it was post-COVID, because we've had a 20% pullback in signed contracts and pending sales. And that's for April. That's not a May number. That's for April. So just a reminder on this life cycle of a listing, we're always trying to get a little bit ahead of the curve, of course. So as early as we can get, that offers the best leading indicator of market activity, both seller and buyer activity. All righty. Let's look at new listings, guys. This is straight from our weekly report. So current year activity in blue versus 2019 in dashed gray. Here again, just a quick note, we were off to a pretty strong start pre-COVID, right? As we saw COVID kind of take hold mid-March, it's pretty plain to see that's a major factor driving these declines in seller activity. So 2019, after this weather, after some of these extreme weather events, we saw 2019 perform fairly well. We did see 2020 almost surpassed these levels from the pre-COVID era, but we didn't quite get there. And again, we've seen these declines this time of year last year, so it shouldn't be too much of a surprise. Actually, maybe this is encouraging to see because even though it was declining last year, maybe we're making up for some of this, or maybe we're making up for a little bit of this. So, stay tuned and keep watching this one. Switching gears over to pending. On the pending side, so on the buyer side, again, one of those leading indicators of demand, or of closed sales anyway. We see what happened with COVID after mid-March. You can see pending sales falling fairly notably, but I suppose it could have been worse. The increase on the pending sales side, on the buyer side, the demand side of the equation, has really been relentless, you guys. These folks have not taken a pause, especially first-time buyers. They're really motivated. Rates are unbelievably low. And don't forget, it's a less competitive and slightly less congested market. So maybe not a surprise that we're seeing buyers really putting up some numbers. You guys will notice buyers easily surpassed this pre-COVID number and have kind of kept going from there. Looks like they actually surpassed that, or at least met up with it May 2nd. And then we've had 3 more weeks of solid gains. I mean, almost linear, you guys. We don't even see the volatility that we've seen last year. So buyers do seem to be fairly motivated and fairly relentless here. The trick, of course, is can we get sellers to comply with that? Can we get sellers to put some of that product on the market? The issue is, where do they go after they list? I think there's a little bit of a game of musical chairs still going, where when the music stops, I got to have a roof to sit under, or a chair to sit on, I guess. All right, so those were well and good, but these are my favorites, just because not only do we show 2020 and 2019 activity, we also show 2017 and 18. I got to be honest with you guys, when I started to see these declines and I started to see us almost retest these lows, almost reach these lows again, we didn't quite, but we did get close. I was a little bit nervous. I thought it wouldn't be great if we sort of went below that. I'd like this level to hold a little bit, and it looks like it will. But notice, guys, in past years, all four past years have shown this decline, near the end of May. So, maybe Memorial Day can signal, a little bit of a change with sellers. And then as we head into June here, we do see that increase. So we always see increases at the beginning of the month, especially after Super Bowl here. We saw a lot of sellers come on in early Feb, and then, kind of tapering off. Here again, early March, we saw a lot of those listings, a lot of those sellers coming on in early March. Of course, this year we had COVID impacting us, but look at the prior 3 years. Here again in early April, we see sellers take that next step up. And then early May, I suppose we kind of see the same dynamic. So it's not surprising to see this. What you see here in 2020, I think is pretty normal. And you guys will notice 2017, 18, and 19 all kind of looked the same. So we came down and then we kind of came up. And this year we're coming down and now we're kind of coming back up. So don't be alarmed by this. I'm not alarmed by this. I was kind of curious and a little bit anxious at first, but I think we're seeing some positive news here. I think it's good that we're finally starting to mimic past years versus not mimicking past years so much. So I'll ask that question again. Can we hold this uptrend, even though it's not quite that slope of an uptrend, but can we hold on to these gains? I think we can. I hope we can, but we'll see. Time will tell. So here we have, again, the buyer side of the equation. And you guys can notice once activity kind of came down, we've seen it easily reach new highs, as we already saw. Came down a little bit, back up, down a little bit again, kind of back up. Again, this is not unlike past years. So nothing alarming here, even though this looks like, some dramatic activity, fairly notable swings. But again, we've also seen that in past years. So I don't think there's anything to be alarmed by here. Let me also talk about demand early on in this year. Look at how strong we were going pre-COVID. You'll notice this trend line, this 2020 trend line in black, was actually a record for, I suppose, not every week or not every day or week so far this year, but for a good chunk of the time. This 2020 trend in black has been above the 3 prior years. So I think that's pretty encouraging. Demand is out there. Buyers are out there, depending on price point. Sometimes they're frustrated, sometimes not so much. So again, it's good that we're kind of mimicking the prior 3 years. Nothing alarming here. In fact, you could even argue this is kind of back on track. Again, we have a little bit of displacement here. I'm not sure we'll make this up. I hope we will. We may. If rates stay cooperative and we do see some extra supply coming on, I do think we could make up, some of that. I don't know about all, but I think we can make up some. So here again, can we hold this trend? I'm much more confident that our buyer trend will hold. I hope sellers do as well, but we'll see. Okay. So here we have change in new listings from week to week. I don't always love doing week to week because, as we saw, you tend to have a surge in listings that first week of the month. I don't know if it's a 30-day, listing contract or 60 or 90 or what have you. Or if folks just want to come on at the beginning of the month because, they know maybe that's when buyers will be out at showings. And so sellers want to be online. So 5/22 to 5/29, most recent period, you guys can see how new listing activity has declined, about 23% overall, but 34% for 3/4 of a mil up to a mil, but only 16% for under 250. So pretty interesting here. How about taking a look at the pending side? So look at buyers, guys. Overall, pending sales rose about 1.7, almost 2% from May 22nd to May 29th. But look at where our big gain was. It was under 250. So even though, well, I guess this makes sense. That was the slightest decline. So technically in new listings, this segment performed the best, or I always correct myself, it performed the least bad. So maybe it's not a surprise that, we did see some strength because we saw the slightest declines in supply here. But also, maybe some other relief and the stimulus checks. I know some folks were furloughed, some are going back, not all. And some are, devising new and creative ways to make up for some of that lost household income. I don't know whether it's driving Uber. I know, not everyone's comfortable getting into an Uber. I don't know, maybe crafting and selling stuff on Etsy, whatever people do, dog walking, mowing lawns, an essential service. So we have seen a little bit of a comeback here, even though this segment was, I don't know if I want to say weak, but this segment definitely saw pretty notable declines early on for the reasons that we discussed. Where did a lot of the job losses hit? A lot of them hit folks in this segment. Interesting 5.5% gain in million plus. I thought that was interesting. Even though there's a 25% decline in new listings, a 5.5% gain in offers, in signed contracts. It's pretty interesting there. I think this one's a little bit better. This one does a better job of sort of this most recent week last year versus that same week this year. You know, it's not perfect, 525 versus 523. But I think this paints a better picture than week to week. So here we don't see that strength in some of our affordable segments. I suppose 190 up to 250 didn't perform too bad, but a 60% decline in new listings in this segment, you know, pretty notable. But again, this is a thin segment. It's pretty hard for sellers. It's virtually impossible for builders to list or build any product at that kind of price point. And I know a lot of the sellers or owners, you know, aren't, well, if this is the payment they can afford, I don't think they're looking to get rid of it. So I think they're kind of hanging on to it because where else would they go? Okay, new listing. So look at this million plus, guys. 17.5% increase in million plus on the seller side. So sellers listed 17.5% more product over a million, but buyers purchased 35% less product over a million. So always interesting when these are moving in opposite directions. We see supply growth in million plus, but we see a contraction in demand. We also see some of the weaker numbers on our pending sales side in our most affordable segments. In fact, I guess the two largest declines were in two of our affordable segments. You know, here again, folks, I see pretty good evidence of our middle market theory. One of the segments that performed the least bad, and two of the two only segments that gained in pending sales were again in these middle market segments. You know, I don't know that a $600,000 or $700,000 home would feel like the middle market to many. So maybe that's a first or second move up. Surely there are some first-time buyers in that space, but maybe not a ton. I think these two are much more common for first-time buyers. You know, overall, only a 9% decline from this week last year to this most recent week this year. So down 9%. Remember, we saw a 20% decline previously. So hopefully this is an indication that things are moderating. Yes, I noticed that PowerPoint had something new, so I just had to play around with it. I think everybody can use a little more beauty and pretty things in their lives these days. Well, there's a message here. So year over year change monthly. I know we were looking at year over year weekly, but now we're going to look at year over year monthly. So let's go back to March, you guys. Again, declines at the low end of the market, some declines at the high end. Most of our gains, the vast majority of our gains, happened in these mid-market tiers. So that's new listings. A pretty similar picture for pendings, right? So our biggest gains came by way of these middle market segments. Decline in luxury. I suppose this is luxury, and that didn't show a decline, but a decline in our highest luxury segment and a decline in our most affordable segment. Okay, a little bit of a warning. Some viewer discretion is advised as we look at April numbers. So just a reminder. And by the way, guys, I will jump into May. So any of you who are thinking of ditching us early here, do stick around for sort of an early reading on the May numbers. Not official yet. Official numbers will be in our actual PDF reports on our website, but I have updated some of the data to get a preliminary glimpse at what transpired in May. So here's April, seller activity, new listing activity in April by price point. I'm already seeing these mid-market tiers, these mid-market brackets performing the least bad, showing some of the smallest declines. You know, only 7%. I don't think that's too bad. Single digits evidently is pretty good. So a 7% decline in new listings isn't too dramatic. But like I said, we had this 21% decline in new listings. Pretty dramatic declines in affordable, fairly dramatic declines as well in luxury. So I know I said pendings were down about 19-20%. I hope I'm right. There you go with your mid-market ranges. Oh, sorry, just a note, you guys, look at where the bulk of our volume is for new listings here. You know, where we see these dramatic declines, they're pretty thin markets. Again, 43%, you know, pretty thin market. We're talking about 100, not even 100, about 75. But look where we're seeing 1,800, 1,500. 1,200 new listings, that's where we see the bulk of our activity, obviously. So I don't know, call it roughly 200,000 up to 500. I'd even say, maybe 250 up to, well, I suppose I should do 200 because look at all the bulk here. Maybe 200 up to 3, or maybe up to 400 or so. So just a note on the volume, you guys. Some of these numbers look dramatic, but again, we're talking 77 showings or new listings or pendings. So here again, pendings, we see our best performers or our least bad performers in these mid-market tiers. I think you guys are noticing a pattern. I feel like I've been saying it a lot, but we do see these middle market ranges performing the best. Declines in affordable, I guess the declines in luxury here aren't too bad. And actually we were perfectly even for 750 up to $1 million. And again, mid-market ranges, and let's just look at the volume. So 66 down to 55, right? A 17% decline, but it's from 11 fewer offers. About 115 down to 75, well, that's 35%. But what is that? 25, 35, 35 or 40 fewer offers. It's not a lot, even though the change looks dramatic. Here again is where we get into 1,300 offers, 1,700, right? 1,000, 1,500, 1,000. We can easily see where the bulk is. So because this was down the least and it's where so much volume is, I think that bodes pretty well for these middle market segments, as we have seen. All right, I promise you guys I'd give you a glimpse of May. Just a caveat for you guys on the webinar, as well as anyone who watches later. I want to say again, these are not official May numbers. It's a little bit of an early glimpse. Our official numbers come in our monthly indicators report, and that's the PDF report that lives on our website. So here we have a little bit of a different trend. I think this is pretty fascinating. Instead of seeing a little bit of a normal, I guess an inverse normal curve here, this looks a little more linear, where we see our largest declines in seller activity in the affordable end, and then we see actually some of our smallest declines in seller activity in the luxury end. Maybe that shouldn't be surprising as we see rising construction costs and whatnot. Maybe some builders and some sellers are looking to get product online, and maybe they think the market might change. It may. I'm not convinced that it will soon. So maybe they're looking to take advantage of some strength in the market. Again, shifting over to pending sales on the demand side, so signed contracts or accepted offers on homes. Here I do still see this inverse normal curve where we have these middle market segments performing the best or the least poorly. Overall, pendings down only 14% versus 2021 for April. So May, not as bad. I hope that means the worst is behind us. I think it is, but we cannot say that with certainty. A 4% decline, not even a 4% decline for a 360, 375, a $400,000 home. That's not a large decline. We see that even if we're not in a pandemic. You can see a +3, -3, +5, -5. So, nothing to write home about here. These are fairly dramatic. This is fairly dramatic, but these really just aren't. So a little bit of this inverted bell curve, inverted normal curve here. Pretty interesting. All right, let's pivot, you guys. I want to pivot. Let's do a quick time check. So we got about 15 minutes left. I do want to walk you guys through this. So let's just do that. All right, let's get going here. There's my Zoom. Well, first things first. So let's just hop onto our website first. Here's that resource page I was talking about. I just want to give a shout out to all the work our team has done. Tele, Ann, Ross, Amy, Eric, and myself. We've really worked hard to get these looking great for you guys and to get all this information in here. So do take a look if you haven't already. And I also want to go back and show you guys, for those who may not be aware, I think you all are, but just in case, all of our many wonderful reports. I'll just click on local market updates. You'll also note that I already have that open, so let me go back. This is Fast Stats. This is where all of our reports live, our official reports. And this is sort of static for the month. It doesn't change. InfoSparks updates every night, right? Every night. If there's, a new listing entered or a status change or, an accepted offer, we show that the next day. So InfoSpark's a little bit more of a live data environment versus what you might think of as a frozen or static reporting environment here. So, I know you guys spend most of your time in the local market updates, but just know we've got the monthly indicators. I'll just give that a click to show it off a little bit. So April numbers, kind of our quick facts, a little bit of our narrative. By the way, guys, please use this. If it works for you, please use this on social media, in mailers, conversations with clients, what have you. Please do use this stuff. We do it for you guys. So there we have it. New listings, April. There we show that down 23%. Pendings, there's our down just over 20%. Closed sales eking out a gain 3.5% versus up 7.33% for the year so far. So this does look like a little bit of a softer number. Days on market down quite a bit. Homes have only been selling about 6.5% faster this year compared to the same month last year. But April, actually pretty notable decline, right? 10 days faster on average. Well, what's going on? I thought everyone lost their job and no one's going to showings. Well, think about it, guys. We talked about how those less motivated buyers or the looky loons or folks looking to go around to listings and make lowball offers, those folks aren't around as much. So we actually saw with those motivated buyers, we saw those offers accepted a little more quickly. So we had a pretty significant decline in days on market. So I think that's pretty fascinating. I think some folks would have expected perhaps some deterioration here as a result of COVID. The ratio of sold to original list price on the rise, up 0.5%, 99.4 to 99.9. So we're almost at 100% compared to the year so far, which is about 98.7. But remember, Jan and Feb are in here in this year-to-date number, and those tend to be a little bit lower, obviously. All right, skip that. I've spent too much time on that. Sorry, guys. Local market updates. Sometimes you see the data and you just have to kind of nerd out on it. So our LMUs, local market updates. Let me just click Hennepin County. Let's see, what should I pick on today? Well, first things first, Minneapolis, we've got all of our wonderful communities that you'll see here. I'll go into Longfellow for no particular reason, and you guys will see all the neighborhoods, Seward, Longfellow, Cooper, Howe, and Hiawatha. I will click on the Longfellow neighborhood. Here we can see specifics on this neighborhood. What happened with sellers? What happened with buyers, right? Wow, closed sales up 20%. What a gain. Well, that's from 5 to 6. So be careful about reading too much into these. And that's exactly why, guys, that's exactly why we have this rolling 12-month average. So overall, over the last 12 months compared to the prior 12 months, we're only noticing about a 4.5% gain. So 20 can look extreme for these reasons. Wow, prices, median sales price. So those 6 sales were evidently higher priced properties. So we saw a 50% run up in prices from about $235 to just over $350. Again, 6 sales, from 5, you can see that movement, some of that extreme movement in thin markets. This is a fairly thin market. Almost all neighborhoods are thin versus looking at the whole city or a county or the metro. Of course, there's some issues with looking at a county. Hey, prices were up in Hennepin County. Well, that doesn't really mean much to folks buying in Golden Valley or South Minneapolis or Edina or Orono or anywhere else, Bloomington or Richfield. Wow, here's an interesting one. Percent of original list price, 107.5% of original list price. So these folks are getting 100%. These, well, I suppose this is new listings. That doesn't mean that these 6 sales happened on these listings. These 6 sales could have happened on product listed in Jan, Feb, March. These are closed sales recorded in April, but they could have been on new listings that happened, I suppose, even last year. So those sellers got 100%. They got their full original list price plus 7.5%. That's how competitive this market is. And no surprise, right? 10 days, down 80%, 10 days. This market has 1.25 months of supply. We're looking for 5 to 6 months of supply. All right, I spent too much time on that as well. So let me pivot for us, guys. My last 10 minutes, I really want to go into InfoSparks. So let's close monthly indicators. Let me just show you guys where to get at some of this stuff. you'll be spending most of your time in Matrix here within the North Star system. Right on this home tab, you guys will see InfoSparks here. Under external links, you guys will see InfoSparks here as well. And then let me just hop into a new listing. What should I pick on today? Waconia, St. Paul, Big Lake. Let's do Chan. Let's do Chan today. All righty. 279 actually looks like a decent one. Yeah, not bad, not bad. All right. So about 1,300 total finish, about 2,500 tax. You guys will notice this is in Chan, and when I click on this InfoSparks link on the listing, notice where it takes me. It takes me to Chan. So it's alive, right? It's kind of we built some intelligence into it. The tool can do a little bit of thinking for you guys, which is nice. No, it's not hard to go in here and start typing Chan and then clicking on it. But hey, when you do that, if you're doing that a dozen or 50 or 100 times a day, if you got someone on your team doing that for all your listings and all your buyers, that obviously takes some time. So we're looking at helping that, at helping you guys and making that a faster process. So here you go, guys. You're looking at the median sales price for May, just about $295. But you'll note for April, 305,000. You guys will note that's actually the first time we've surpassed 300,000. And I will go ahead and go on the record and say it was kind of a funny time for that to happen, wasn't it? April, March, April. Well, I suppose April, that was one of the worst months of the pandemic so far, kind of happening mid-March. So I guess the second half of March was pretty bad as well. But April, first time we hit over 300,000. So I thought that was interesting. Come down just a little bit. But again, guys, look at May, right? We tend to peak in, I guess, sometimes June, sometimes May, sometimes June, maybe June. Here's a June. I suppose it is more June. But pendings, if I switch to pendings, look when pendings peak. April, May, 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 May again. Well, folks, here we are in May. There's a decent chance we may have seen the peak on pendings. Because of this little dip here, which we didn't quite see in other years, maybe there's some pent up demand where we could, have a June. I know we've had Junes in the past. See if I can find one. Of course, I won't. Here's a June, I suppose. That was just after the Great Recession, so that was a little wonky. This one's going to be April because of that tax credit, where those offers had to be written in April. So that one's a little wonky as well. I guess June, I'm not really proving my point here. There's a May, so I suppose kind of pre-crash, we were back to, actually this was April. So yeah, April, May being the peak. And again, recently, May is pretty reliable for the peak in pendings. Let's just shift to new listings really quickly. New listings continue to come on. May was a peak here. May was a peak here. May was a peak here. It's possible May's a peak here, but again, to make up for some of that decline, a little bit of this blip, it's possible that we see a gain into June. I think it would be nice, given the fact that we have less than 2 months of supply, right? 1.9 months of supply. Late last year, early this year, we were down to 1.7. As we were heading into our bubble, we had 11 months of supply, so well above that 5 to 6 month range that we think of as balanced. Alrighty, 5 minutes left, guys. Let me just do some breakouts for us. Let's do new listings, and let's break this down by property type. So, I think you guys are pretty comfortable with changing metrics here, just kind of clicking on our different indicators. Just a reminder, you guys can filter down to single family, right? You'll notice that here. You can filter down to condos. You'll notice that again here. But what I'm looking at doing is breaking this out. So instead of filtering, I'm going to use our breakout button or our breakout button. That is kind of that sideways V, sort of that splitter arrow. So let me give that a click, and you'll see now all of these different property types are plotted out on the same chart. So we basically itemize these out from the whole market, from all property types. I want to itemize out or break out all of these individual property types. I'm going to shut down townhouse condo because we've got those individually. I'm also going to shut off all because I don't care about all. I care about these three major individual segments. All right, new listings. I don't know that a line chart is the best way to look at this. I suppose you can see all the seasonality. What I'm looking at doing again is let's switch to bar charts. All right, May, again, this is preliminary, but we saw a 26% pullback in new listings for single family. Interestingly, only a 25% pullback for condos. Looks like our best performer, 21% pullback for townhomes. Let's look at pendings though. Okay, only a 10% pullback for single family. Looks like that's our best performer. Still see some fairly notable declines in condo offers, 38% down for condos. So roughly 4 times the decline in pending sales. The way I'd say this is condos had roughly 4 times the decline that we saw in single family. Townhome somewhere in the middle, 20%. So not too bad, but fairly, I hope it's not too radical or forward thinking or of a statement to say, we believe that with the health issues, it's understandable that there's some concerns around these properties. I suppose there's a lot of rental buildings, a lot of large rental buildings with 100, 200, 300 plus units, a lot of shared space in those too. And, mostly those are still leased up, maybe minus some of the luxury rentals. So yeah, you can still see COVID impacting these condo numbers. Market times, all right, 27 up, not a surprise, right? 28%, 21 days to 27. So what about 3 weeks up to 4 weeks? Only up 12% for townhomes and actually down 6 1/3%, but only 1 day, right? Sorry, from 16 to 15 days for single family. All right, in my last couple of minutes, I want to do a price range breakout for you guys. So let me get back to all, and I'm going to shut this breakout off or just kind of go back to all. Let's look at price points here, guys. If you want to filter down, you can do that. If you want to break out what you've got, these pre-baked ranges, you can do that. I'm interested in breaking out my own custom ranges. So you can just kind of start, doing your work here. I like to clear them out. Let's use really broad categories, you guys, 250 up to 499, 500 up to 999, and then $1 million or more. So sort of, kind of intuitive breaks, even though, yes, I understand there's a huge difference between a $550,000 home in Lakeville and a $950,000 home in Edina. I get it. There's a big difference. But just for the sake of argument here and for the sake of a demonstration, let's just use these price points. Here again, we can filter, or we can break out. I like to break out because I want to see what's going on. Wow, already I can see a nearly 200% increase in market times for million plus in May. So a pretty dramatic change here. Most affordable segment under $250,000, up a little bit, about 14%, a little slower. 250 up to 500, a little faster. About 12% faster. So here's where you have your 350, 325, 425 homes. This, what did I call it last time? This young luxury segment, or this early or lower luxury segment. 550 may not seem like luxury, but 850 and 950 surely are. Pretty notable decline, down 40% from 41 days down to 24. So that's pretty notable, and we've shown that segment. In our other charts and other visuals, we've shown that segment to be performing fairly well. A quick check on absorption rates. Here's our tightest market by far, this affordable end, under 250K. 1 month of supply, folks, 4 weeks of supply. We're looking for 5 to 6 months. Next bracket up, about 2 months of supply, $500,000 up to $1 million, about 4.25 months of supply. Over $1 million, we still have a pretty notable oversupply issue with 11.25 months of supply. So 5 to 6 is balanced. Over 6 is kind of a seller's market. Sorry, a buyer's market. Under 4 or 5 months is, guys, oh my God, that's terrible. Over 6 months is a buyer's market. There's a lot of supply relative to demand. Under 5 months is a seller's market. It's a tight market. Sellers have pricing power, negotiation, negotiating leverage. They don't have to do a roof replacement or a boiler or a furnace or a water heater, or sand and stain the hardwood floors if they don't want to, especially if they've got 2 months of supply or 1 month of supply. Odds are pretty good they've got 5 offers waiting in the wings. And if you're gonna, mess around and make me do all these fixes from inspection, or have all these contingencies, maybe I look at a better offer. So interesting stuff there. Let's just look real quickly, guys. New listings, down and affordable, down also in this next rung. So I guess down across the board for new listings, not a surprise. Let's look at pendings here. Again, our best performers seem to be in the middle. Notable declines in affordable, and I guess more notable declines in luxury here as well. So because there's an oversupply issue up here in the luxury bracket, it makes sense that those sellers are having to make concessions, right? They're having to concede a little bit on price. So they're only getting 93% of their original list price. Look at the other brackets, guys, 100%. Oops, sorry, 100%. Previously, 100.6%, 100.2. Now at 100, still nothing to sneeze at. Again, 100% quarter mil up to half a mil. And then here we do see gains, 99.3% for this half a mil up to a mil range. So pretty interesting stuff there. Alrighty, I see we are 2 minutes over time. That means I should open it up to questions and eventually let you guys get back to your lives. Let's check questions. I see none.
Yeah,
must mean I did a half decent job, huh?
You always do an excellent job, David.
Well, just before we close, I want to again give a thank you to our sponsors, Bell Bank Mortgage, North Star, Royal Credit Union, and Supra. I want to also say there will be a recording of this webinar available on our COVID page, which I showed you guys. I, of course, encourage you to join us next week at this time for all the latest updates so we can continue to nerd out and geek out on this data, especially nowadays. Nerds of a feather have to flock together. Most of you know registration is required. The link's on our homepage, mplsrealtor.com. I want to also give a shout out to my colleague, Eric Myers. I encourage you guys to check out his webinar. That's Mondays at 1. Again, he does a really great job discussing all the policy changes at all levels. And I also love that it's called Gab with Your GAD. And should I turn it back to you, Anne?
Sure. It looks like if we don't have any questions, we can probably wrap it up for today.
Beautiful. Want to say thanks again to everyone and our sponsors, and have a wonderful day.
Thank you, David.
You betcha.